Hello, all. I'm Mamta Rawat from the Corporate Communications team at CareEdge Ratings, and it's my pleasure to host today's webinar on hospitality at an is the Upcycle. Thank you for taking the time out to join us. Before we begin, I'm delighted to introduce our guest speakers for today. Mr. Vivek Group, Mr. Rajat Mehra, Chief Financial Officer at Sami Hotels, Mr. Vinay Gupta, Vice President, Asset Management and Development at Interglobe Hotels, Sabyasachi Majumdar. We would like to inform our audience that Mr. Rajat Mehra could not join us, precedented. Any question, please type them into the panel. We will address them towards the end of the session. With that, may I invite Swatantra Swanim to begin the proceedings with his presentation.
Good afternoon, everyone. Today, we'll be sharing CareEdge's perspective on the Indian hospitality sector, an industry that continues to remain in a strong upward cycle. This growth is being powered by robust domestic travel, improving infrastructure, and sustained economic momentum. In FY25, the sector delivered yet another structurally strong performance, and the trend is expected to continue in FY26. To set the context for the flow of today's presentation, the key takeaways are demand continues to remain strong, supported by multiple structural drivers and large-scale events. On the back of this healthy demand, average occupancy levels are expected to sustain at 65 to 67%, even as new supply enters the market. Domestic travel remains the backbone of sectoral growth, but international travel is steadily inching closer to pre-pandemic levels. Supported by the improved ARRs across segments and stable occupancies, industry revenues in FY25 grew stronger than expected. Going forward, the revenues are still projected to expand at a healthy CAGR of around 6 to 7%. Over the medium term, demand is expected to outpace supply, benefiting industry players. We also anticipate an increasing share for the upper mid-scale and upscale segments over the next 2 to 4 years. Importantly, the credit profile of the hotel players strengthened in the last 3 years and is expected to remain so. We will take a closer look at each of these takeaways as we proceed. We have structured this presentation into three key parts. First, we'll look at the broader trends in the travel and tourism sector, where domestic travel continues to act as the primary demand engine, while foreign tourist arrivals gradually recovers amid ongoing global uncertainties. Next, we'll shift our focus to the key trends shaping the Indian hospitality sector. And finally, we'll examine the credit profile of the hotel players, along with CareEdge's rating outlook and our perspective on the road ahead. Indian economy currently ranks 8th in the world in terms of total absolute contribution of travel and tourism sector to world GDP. Here, in Exhibit 1, the light blue bars represent the absolute contribution of travel and tourism to India's GDP in USD billion calendar year-wise, and dark blue line is the year-on-year percentage contribution the travel and tourism sector contributed to India's GDP. The travel and tourism industry, being highly cyclical and closely linked to discretionary spending, has demonstrated pronounced volatility across economic cycles. In 2020, the sector contracted sharply by 43%, reflecting the impact of stringent nationwide lockdowns during COVID-19 pandemic. However, the rebound was equally strong. Importantly, share of economic contribution has remained stable since 2023 as overall spending normalized to pre-COVID year or surpassed the same, indicating a structurally restored demand environment. From a forward-looking perspective, government-led infrastructure push, new airports, roads, networks, and theme-based circuits continue to reinforce tourism as a structural contributors to India's economy. As a result, the Indian travel and tourism industry is projected to grow at a CAGR of 7 to 8% over the next decade, reaching an estimated size of USD 520 to 545 billion by 2035, with a materially higher contribution to overall GDP. Here, in Exhibit 2, domestic air passenger traffic has been depicted for the last 6 fiscals in India. Likewise, in Exhibit 3, similar data for FTAs in India has been depicted. Post-pandemic, domestic air passenger traffic has shown a sustained and consistent upcycle, comfortably surpassing pre-COVID levels. While growth moderated in FY25 due to a higher base, overall passenger volumes continue to rise, reflecting stronger connectivity and an expanding middle income traveler base. Today, domestic travel serves as the core demand stabilizer for hotels, helping maintain steady occupancies even when international travel faces headwinds. Even in the current year, the first half numbers indicate that domestic travel demand remains resilient and broad based. FTAs have also recovered meaningfully from the COVID trough, but the pace is more gradual and uneven compared to domestic travel. While FY24 and FY25 show improvements, FTAs are still below their long term potential, reflecting global macro uncertainty, geopolitics, and slower recovery in long haul travel. As FTAs normalize further, especially in the premium and gateway cities, this can provide incremental upside to the ARRs. But even in the absence of a full international recovery, the sector today is far better positioned than pre COVID, driven by a structurally stronger domestic travel base. Now, the trends in hospitality sectors. In here, the bars represent the revenue per available room, RevPAR, while the green line tracks average occupancy level. This slide brings together the two most important drivers for the hotel sector, demanding and pricing, and explains why the outlook remains constructive. If we look at the historical trend between FY15 and FY20, the sector was in a moderate recovery phase. Occupancies were stable in the low 60s and RevPAR were gradually improving, but growth was measured. During COVID, the hospitality sector witnessed the most severe downturn in history, with RevPAR declining by nearly 66 to 70% compared to FY20 levels. However, this shock also triggered meaningful supply rationalization as several underperforming properties exited the market. From FY22 onwards, RevPAR rebounded sharply, driven by two key factors: a revival in travel sentiment following successful vaccination drives, and a tighter supply base with fewer rooms competing for rising demands. The recovery strengthened further in FY23, with RevPAR surpassing the pre pandemic levels by 9%. This growth momentum continued with a 14% increase in FY24 and a further 8% rise in FY25. Looking ahead, supported by multiple structural tailwinds, average room rates are expected to grow at a CAGR of 6 to 7%, while occupancy levels are projected to stabilize in the 65 to 67% range. As a result, RevPAR is estimated to grow by 7 to 8% in FY26 over FY25 levels, thereby supporting a stronger and more stable credit profile for industry players. So, the key message is this: the current upcycle is healthier than the previous one, backed by strong demand fundamentals, improved pricing power, and relatively contained supply additions, which underpins a stable to positive sector outlook. Now let us look at ARR and occupancy trends in major cities. Gateway cities continue to anchor hotel sector performance, driven by strong occupancies and firm pricing momentum. Delhi NCR and Mumbai lead with FY25 occupancy nearing 79 to 80%, supported by diversified corporate, government, and event-led demand. Bangalore and Chennai show steady improvement as business travel strengthens, while Hyderabad remains stable at 76 and Kolkata and Pune record gradual uptakes. ARR have risen across markets, with Mumbai and Delhi maintaining premium rates of 11,900 and 10,500. Bangalore, Chennai, and Hyderabad report healthy rate expansion, reflecting improved weekday corporate traction. When combined, these trends drive strong RevPAR outcomes. Mumbai and Delhi lead in absolute RevPAR, while Bangalore and Hyderabad deliver the fastest year-on-year growth, signaling robust demand recovery. Overall, FY25 RevPAR gains stems from a balanced mix of higher occupancy and rate discipline. Looking ahead to FY26, gateway cities are expected to strengthen further as corporate travel, business sentiment, and controlled supply continue to support the sector's structural upcycle. Now, let us look at key market drivers. The current hotel upcycle is being sustained by a powerful combination of domestic demand strength, business travel revival, and policy driven enablers. At the core is the domestic demand, where leisure travel continues to act as a foundational pillar. Strong weekend getaways, holiday tourism, and family centric travel patterns are supporting consistently high occupancies. Alongside this, weddings have emerged as a premium demand drivers. Rising incomes, destination weddings popularity, and large banquet requirements are fueling steady ARR growth and strengthening year round demand. On the business side, the sector is benefiting from significant MICE momentum, with large convention centers driving corporate events, trade shows, and global gatherings. This has boosted weekday demands and enabled hotels to maintain pricing discipline. Business travel tied to technology, fintech, investment summits, and global event continues to provide a stable base that complements leisure-driven peaks. The country is aiming to host international sporting events like the 2029 World Athletic Championship, 2030 Youth Olympics, and 2030 Commonwealth Games. Supporting these demand drivers are strong policy and infrastructure tailwinds. Government initiatives in transport infrastructure, regional connectivity, and tourism development are expanding viable hotel markets. Meanwhile, major MICE enabling facilities in Mumbai, Delhi, Hyderabad, Bangalore, and Gandhinagar are elevating India's capacity to host large format events. Together, these demand engines and policy enablers position the sector for sustained growth through FY26 and beyond. Now, let us have a look at the key budget announcement. The latest budget introduces several initiatives to accelerate tourism growth. A National Institute of Hospitality will be developed to strengthen skilled manpower. There's a strong push towards spiritual and medical tourism, along with sustainable tourism trail development. 20 iconic tourist sites and will undergo major upgrades, supported by improved regional air connectivity and seaplane manufacturing. Additionally, a pilot scheme will upskill 10,000 guides across 20 major tourist sites. The measures are likely to support stronger revenue visibility and diversify earnings for hospitality operators. CareEdge Rating expects the initiatives to have a positive credit impact on organized players in the sector, reinforcing growth prospects and financial resilience in the medium term. This slide highlights how India's branded room supply pipeline is expanding in a disciplined and demand-aligned manner. As shown in Exhibit 4, branded room inventory has nearly doubled over the past decade from 94,000 keys in FY13 to approximately 1.96 lakh rooms currently. Looking ahead, the next 5-year pipeline adds another 1.14 lakh keys, taking total branded supply to around 3.1 lakh rooms by FY30. Importantly, supply growth reflects clear cycle discipline. Additions were elevated at 11.8% in FY13 but moderated sharply to 7.3% in FY14, 6.4% in FY15, and 3.6% in FY16 as the industry corrected earlier oversupply. Post-COVID, growth accelerated but in a measured manner at 3.6% in FY25, a sharp rebound of 10.7% in FY23, followed by 8.4% in FY24 and approximately 9.3% in FY25. This calibrated expansion ensures that supply continues to trail demand, thereby supporting ARR growth and occupancy sustainability through the current upcycle. Exhibit 5 further highlights a structural shift in the supply mix. The mid-scale and economy segment has expanded significantly from a 22% share in FY15 to 38% in FY25 and is expected to account for around 35% by FY30. The upper mid-scale segment has increased from 19% to 24% with projections of 29% by FY30. Upscale has grown from 23% to 29% and is expected to stabilize near 32%. In contrast, the luxury segment has moderated from 10% to 9% and is projected to decline further to about 5% by FY30, reflecting more selective destination-led development. Overall, this evolving supply landscape, characterized by moderated pipeline, a stronger mid-market orientation, and calibrated luxury additions, support healthier absorption levels, stronger occupancy resilience, and sustainable RevPAR growth through FY30 in CARE's view. Having reviewed the total supply at the pan-India level, we will now turn into key markets in Exhibit 6. Delhi NCR, Mumbai, and Bangalore continue to anchor India's branded hotel landscape with inventories projected to reach 30,000, 20,000, and 25,000 keys respectively by FY30. Bangalore leads the pipeline with 8,684 keys under development, followed by Delhi NCR and Mumbai. Beyond these gateway markets, Chennai, Goa, Hyderabad, Jaipur, Kolkata, and Pune are seeing steady additions from smaller bases, positioning them as high-growth secondary markets. This slide brings out three clear themes. First, gateway cities continue to dominate, accounting for roughly 17% of the incremental national supply. Their deep corporate base and diversified travel demand significantly mitigate oversupply risks. Second, structural demand anchors, particularly IT growth and business travel, are driving strong absorption in markets like Bengaluru, Hyderabad, and Pune. Third, emerging cities are steadily gaining traction, supported by rising regional travel and expanding technology driven ecosystems, strengthening their medium term growth potential. Now, let us have a look at the key financial metrics of the players across the industry. Hotel revenues are inherently cyclical, given the demand driven and price elastic nature of the business, coupled with lumpy supply side additions. Starting with Exhibit 7, the revenue trajectory clearly reflects this cyclicality. FY21 marked the trough with a steep 53% decline due to COVID disruption. This was followed by a sharp 120% rebound in FY22 as travel demand returned decisively. Growth then normalized at 20% in FY24 and 30% in FY25, supported by strong occupancy recovery and robust pricing power. Looking ahead, revenues in FY26 and FY27 are projected to grow at a more sustainable 6 to 7% CAGR, largely driven by ARR-led expansion on elevated FY25 base. The key takeaway here is that the volatility has tapered off, but the revenue base has structurally reset to levels well above pre-COVID benchmarks. Turning to Exhibit 8, EBITDA margins were steady at 15 to 18% before COVID, then declined sharply during the pandemic. They have since rebounded strongly to around 28% by FY25, driven by leaner cost structures, higher staff productivity, and improved pricing discipline. Margins are now expected to stabilize in the 28 to 29% range over FY26 to 27, suggesting a structural reset rather than a cyclical spike. That said, there are natural moderating factors. Employee costs, which had corrected significantly during the pandemic, are gradually rising again. Corporate overheads are also expected to increase as brand expands and scale operations. These factors are likely to cap further margin expansion. Overall, the industry enters FY26 with steady revenue growth, structurally stronger margins, and a far more resilient financial model compared to the pre pandemic period. Any sharp decline in the key performance indicators owing to macros environments or exogenous factors and significant surge in cost remain a downside risk to our assumption. With the improvement in revenue and profitability, leverage and coverage metrics have strengthened materially as highlighted in this table. Interest coverage ratio, which averaged between 1.8 times to 3 times in the pre-COVID period, rebounded sharply post-pandemic, rising to 6.25 times in FY25. It is further projected to improve to 6.5 times to 7 times over FY26 and 27. At the same time, debt to EBITDA has corrected significantly. From a peak of 7.65 times in FY22, it declined to 1.7 times in FY25 and is expected to moderate further towards approximately 1.5 times by FY27. This improvement reflects both strong EBITDA recovery and disciplined balance sheet management. Return metrics have also structurally strengthened. Return on capital employed, which had dipped to negative 5% in FY20, improved steadily to 9.3% in FY24 and 10.3% in FY25, and is projected to reach to 11 to 12% by FY26 and 27, even as expansion plans continue. Overall, stronger operating performance, lower effective leverage, and improved capital productivity are enhancing balance sheet comfort and reinforcing the sector's long-term financial resilience. With improved financial metrics, the credit ratio for the sector, which is calculated as upgrade to downgrade, also witnessed stark improvement and stood at 13 as depicted in Exhibit 11. FY21 and 22 were the years where significant amount of downgrades happened owing to worsening of operating metrics and a stretched liquidity for few players, which is visible in the low credit ratio. Exhibit 12 represents the rating dispersion for care-rated players in the sector. 31% of the rated entities, which have about 18% of the debt that CareEdge rates, is in below investment grade. These are largely all small players. 69% of the rated entities with 82% of the rated debt is in investment grade. Having talked about the industry dynamics and credit profile of the players, let us look at the structural tailwinds in the sector, and here we will also briefly touch upon the key monitorables. Among the tailwinds are country's strong consumption-led growth bias, with rising middle-class households increasingly prioritizing leisure and experience-based spending. Formalization of demand and supply with accelerated shift from unorganized to branded hotels. Demand remains healthy across segments, including tourism, business travel, and events. Medical tourism is expanding, and MICE-related activities are becoming more decentralized beyond major metros. Complementing this is the continued infrastructure and connectivity push, enabling smoother travels and making smaller cities and regional destinations more accessible. Additionally, asset-light models and platform-based hotels strategies are gaining traction. However, several risks which warrant close monitoring include the geopolitical environment remains a potential disruptor with global tensions influencing foreign tourist arrivals. Prolonged increases in the room rates may stretch affordability in price sensitive and leisure heavy markets, affecting occupancy momentum. Normalization in the key performance indicators, stability in the smaller markets, and the return of fixed costs such as staffing and refurbishment capex may also pressure margins. The depth and resilience of demand in Tier 2 and Tier 3 markets also remain relatively untested through a complete economic cycle, posing execution and brand pull challenges. With this, we come to the end of our presentation. Thank you, everyone. I now hand back over to Mamta.
Thank you, Swatantra, for that comprehensive overview. A quick reminder to all attendees, please keep sending in your questions. We'll take them up during the Q&A. Now, I would like to invite our moderator, Ravleen Sethi, to take the discussion forward. Ravleen Sethi serves as a director at CareEdge. She's a qualified chartered accountant with over 14 years of extensive experience in corporate accounting and credit rating. Throughout her career, she has demonstrated expertise across a broad spectrum of industries, including cement, hospitality, healthcare, sugar, among others. Over to you, Ravleen.
Thank you, Mamta. And thank you, Swatantra, for setting the context for today's discussion. What we want to explore today is not just, how strong the sector looks like, but how sustainable this strength really is as we move into the next phase of the cycle. So to do that, I'm very delighted to be joined by a very strong panel and who brings perspective from operations, ownership, and capital. Let me briefly introduce you our panel. First, we have with us Mr. Vivek Shukla, Chief Executive Officer at the Lalit Suri Hospitality Group. Vivek comes with over 4 decades of experience in the hospitality domain, out of which 21 years have been with the Lalit Suri Group. An alumnus of 1992 batch of IHM Mumbai, he has also held key positions with other brands such as Hyatt, Marriott, Taj Group, and the Oberoi as well. Welcome, Vivek. Next, we have with us Mr. Vinay Gupta, who's the Vice President and Asset Management and Development with Interglobe Hotels. Vinay has over 30 years of global hospitality experience, having worked in UK, UAE, Australia, and India with leading brands such as Accor, Hilton, Marriott, Hyatt, and Intercontinental in various roles. And he's also worked with various shareholders and asset owners as well, like Equity International, Goldman, and GTI. He's an alumnus of IHM Pusa and holds a BA honors from Lancaster University as well. His career spans across key roles in operations, brand development, and strategic brand partnerships. Welcome, Vinay. Finally, we have Mr. Sabyasachi Mazumdar, who's a Senior Director with CareEdge Ratings. He's a Senior Director with Care Ratings and has over 25 years of experience with rating agencies. He's an alumnus of IIM Lucknow and is heading power sector along with major corporate sectors at Care from last 2 years. Prior to this, he's been with ICRA for over 2 decades in his previous role. Thank you, Sabu, for being on the panel, and we'll have some credit views from your end. So let me start our discussion by focusing on demand, which is clearly the foundation of everything we're seeing today, and like Swatantru also spoke on the presentation. So Vivek, let's hear from you first. We've seen demand broaden beyond just peak seasons and metro markets in these last 2 to 3 years post-COVID. So from your perspective, do you see this as a structural shift in how and where people travel? Or in some of the current strength, still cyclical, you believe, and vulnerable once the broadened economic cycle kind of normalizes?
So thank you, Ravleen, for that question, and thank you for inviting me for the wonderful webinar today organized by CareEdge, and I'm thankful to all the organizing committee for this back end at the CareEdge. Thank you for having me and I'm really proud to be a part of this. Well, the demand, in my opinion and in our opinion, is definitely there. There seems to be no downside to what we are seeing as a sentiment across the country. And we are very proud that we are in a very good position right now, very strong foothold of managing more and more demand. Yes, the supply could be limited in various parts with tier two, tier three cities. Even tier one is falling short with what we are witnessing across. There definitely is an upswing. There has been an improved connectivity all across, improved infrastructure with airports, railways, highways, showing us the way that the domestic travel is here to stay. It's only gotten better year on year post COVID, and it is definitely here to stay and make our industry more resilient and strong. And all I can say is that there is a various mix that is now India is witnessing across travel, apart from domestic. There are weddings, there is MICE, there is spiritual and religious tourism, there is medical tourism that is bringing in and attracting individuals from all walks of life across the country. And we are definitely at a very good pace. Thank you.
Okay, sure. So that's interesting. You're talking, I mean, so the demand seems more diversified maybe from the early
Yes,
cycles. So do
absolutely.
you also believe that this diversification itself will lower the volatility for the hotel operators, even if the growth kind of moderates? Because, we're already at a peak. Last 2 years, we've been kind of reporting a double-digit growth.
Yes. No, I think this is here to stay, and the sentiment definitely is stronger and bullish for this year as well. Against all odds, with whatever is happening geopolitically, that India is also witnessing in many ways, there is an upswing towards this particular current upcoming financial year that we will see. There will be a strong business sentiment. So it should not plateau at all. It should only go up. Thank you.
Okay, thank you, thank you. Let me get you Vinay over here. Traditionally the gateway cities have been the safest anchors for the hotel demand, and over the last 2 decades or 2 years, probably, sorry, the tier two and the tier three markets, they have surprised us on occupancies and pricing as well. So, do you still see the gateway cities as the most stable demand markets, or the smaller cities now kind of offering better risk-adjusted growth?
First of all, thank you, Ravleen, and fellow panelists. So good to be here. And look, first of all, Indian hospitality market is still in a growth phase, and it's a lot more sustained than what we have experienced in past. There is a structural change in what we are experiencing today. So it's not few years journey, it's a decadal journey. Let me give you some contextual numbers why I say so. In fact, Indian airports are leading. 10 years ago, we have all heard we had 70 airports. Today, we have 160 airports. There are 15 new airports are to open in next 5 years. Now, let's contextualize in a gateway city perspective. Delhi is 9th busiest airport in the world, handling 80 million people. Compare this with Delhi room supply of a branded hotel is 60th in the world compared to 9th busiest airport, with 25,000 rooms currently available, another 5,000-6,000 in a pipeline, as compared to 150,000 in Dubai, kind of a city. So our airports have leaped and frogged ahead. So with this, convention facilities, diverse demand base, pro-business, international travel is still very, very modest, representing only 15% of the total passenger data travel. So in the airport, 85% of the traffic is from domestic market. As these structural changes keep coming into play, we have a very long journey for hospitality ahead. Now, coming back to tier two versus tier one, again, tier one leads with large grade A office supply. So greater quality of airports, greater quality of road network. Again, in the country, we have more than doubled our road network in last 10 years. Today, it's like a 50,000 kilometer road network. Tier two cities with Udan kind of initiatives, religious infra built up, awareness built up. I think where the larger opportunity lies is creating that marketing campaign for India tourism. I think that's still a missing link in our demand drivers for the tier 2 cities. Tier 2 is still very weak in terms of grade A commercial. So you are largely in a tier 2 city dependent on either leisure or social led demand.
Correct.
SME contributes, and hence when your colleague was taking us through the presentation, he talked about a lot of mid-scale supply growth, and that mid-scale supply growth is reflecting of a tier 2 market, which has a limited appetite for larger hotels. It has a more compressed rate market, whereas gateway cities have a far greater pricing ability, but still there's a long way to go. Again, we talk about 10-15% rate growth year on year for last 2-3 years. But as a country, we are still sub $100 country. If you go to any of the global gateway cities, when we compare top 9 airports ahead of us, each one of them have $300-400 average rate for a branded hotel in a 4-5 star segment. So that's where I see the demand. We depended largely on corporate, little bit of leisure. I think leisure we've built up. Again, another demand and a supply side data point. I think India sends out about 4 million international tourists, and we get only 1.5 million international tourists coming into India. Inbound is that much shorter. So that needs to be boosted up. And that's how I see. So I'm very, very optimistic and bullish, and being an asset owner and owning 30 hotels with Interglobe, it gives us joy that the structural change is coming into play. And it's only upside from here. And it has to be sustained for years for it to be fairly retributed to the investment and time put into this.
Thank you, Vinay, for that. That was a very interesting data point on Delhi that you shared. So stability, according to you, is still with the gateways, like you're talking of the MICE and the other things. But tell me one more thing, over here, there's a strong push from the government in the tourism infrastructure. According to you, what you seeing this on the ground, how much of this is actually translating into the incremental hotel room nights today? Or would it be, as we go ahead? Because last year also there was a lot of focus on the tourism, so is this year.
Yeah.
And most of this kind of a tourism and the development which is kind of being announced is again, the tier 2 and the tier 3 markets, which we kind of hear. So any thoughts on that?
Yeah. So look, this is the most welcome change where tourism has started to find its place in annual budget, national budget, that commentary. It was never the case in past. However, to make the changes happen on the ground, it's still a longer journey ahead. We need to build the networks better. We have to get those all 50 new airports, which we are talking about, connectivity through Udaan. We have to market the India. Incredible India was a great campaign. We need to resurrect some global campaign to bring people and make that, obviously, infrastructure comes ahead of that. But to make a significant change on the ground, it's still early.
Okay, sure. Thank you. Thank you for that perspective. Sabu will get you over here, though earlier in the presentation, CareEdge, houses kind of shared the view. But if we step back from the segment level data, that we keep on looking and we look at the broader economy, the rising disposable income, the formalization of the business, the infra spend, which is kind of happening. How do you see the hospitality positioned within India's growth story? So what should the hotel players be doing differently today to ensure that demand sustains beyond the current upcycle? Like, what's our view, especially in areas like maybe revenue management?
Okay. From a macro perspective, hospitality business is increasingly becoming a structural rather than a cyclical beneficiary of India's economic growth. Factors like rising urbanization, higher discretionary income, improved air connectivity, and formal corporate travel are creating a broader base of demand. However, to translate this demand into a sustainable revenue stream will depend not only on the macro factors, but also on how the operators go about institutionalizing their commercial discipline and approach. So we can broadly look at three areas where the operators have to position themselves. First is on the revenue management. Basically, they need to move away from reactive pricing to data-led yield optimization. Secondly, having better product offerings to facilitate demand diversification, not being purely dependent on one sector, such as, let's say, corporate or leisure, but also to have, additional, basically to balance corporate, leisure, MICE, weddings, all, there needs to be products for, all segments, including, F&B and so many other things. Finally, of course, cost discipline will be the third pillar. Basically, cost optimization through efficiency, resulting in margin protection even when, the growth moderates or, the prices under some pressure. So you need to maintain your profitability. So if, operators execute all these three pillars well, the sector can avoid the sharp volatility that we have seen in previous cycles.
Okay, thank you. So basically, like we all, argue it out from credit rating agency perspective that the macro tailwinds they're creating opportunity, but what we are also kind of seeing is the disciplined execution will convert into sustainable returns for these players. Right. So this maybe, naturally leads me to understand a little better from our panelists, how supply is being added across markets and segments. So, Vivek, if you can please help us, today demand, like we are talking, like you and Vinay also spoke of the demand is clearly running ahead of supply, which is supporting the occupancies and pricing across markets. We can see even in the gateway or the tier two, tier three. But if we look a little further, ahead, say beyond FY 27 and 28, how does the new hotel supply pipeline shape up according to you, on ground? And also, do you see the current demand supply balance still holding, or there would be pockets where supply could start catching up faster than the expected?
Uh, I think that's a very interesting question. In India, like my fellow panelist, Mr. Gupta mentioned, uh, we got to look at long term. We have to look at a decade from now. The demand is so robust that the supply is unable to catch up. Uh, Even though infra is being given a lot of push, and the agenda of the government is to, from ease of doing business perspective, uh, we have to come together in ensuring that our supply is able to meet the demand. Currently, we are not able to. Uh, Tier one cities, supply is there, but then under different segments, it's still craving for more, be it
Yeah.
any segment of a category of a hotel kind of category. Similarly, tier two and tier three is definitely showing the way that it really needs some very good uh, players out there, some good brands out there, uh, great spaces where they can, with ease and comfort, uh, convey and a larger segment that they can cater to, be it in terms of hosting weddings or hosting any kind of a MICE event, even hosting any kind of a corporate event for that matter. The travel is there. Even wellness is taking up a big interest in our country, and folks across the country are traveling for wellness, and there is wellness tourism conclaves taking place today, which I think in the international domain is something which India leads the way, be it yoga, be it Ayurveda, be it spiritual awakening and tourism, and we have so much in abundance to offer. And yes, the supply will always be less for the demand that we see. So there won't be a plateau taking place. There will be an upswing that will be there in the demand in the coming financial year and many more to come, if I may say. So very clearly, the mix of the trend is here to stay. It exists, and it is very much robust and strong in our favor as hospitality industry. Thank you.
Okay, sure. Uh, Vinay, maybe what's your view? We are seeing a sharp increase in the hotel signings through these management contracts and the other asset-light models as well. A lot of the players, initially who were kind of asset heavy, they went on a big way in the last 2 years. We've seen a lot of announcements, a lot of listed players as well, and the otherwise. So from your perspective, how do you see, what's a healthy balance between the two? And how sustainable is this shift for both the operators and developers over the medium term?
Very interesting question, Ravleen. Look, growth in hospitality has to lever both operative side and a balance sheet side. Balance sheet creates a perpetuity infra, and even in a management agreement, that hotel is sitting in somebody's balance sheet. You can't sell a hotel without having a hotel. It's not a digital product, it's a physical product which requires real estate construction, and it's infra in nature. Now, how the P&L impacts or the value creation happens depends on how you deploy your greatest strength. So Interglobe has built 30 hotels, in large percentage of that in a gateway cities. Our skill is to build on far more efficiently, and what we call GFA, gross floor area. We built at one of the finest and the sharpest. So our construction cost is very efficient. What Sabyasachi was talking about, how the down cycle you protect is by building efficient. You inherently design your building to be more efficient than the competition. So our buildings in down cycle would always perform better than the competition. That's how we have designed them. In terms of structural changes, whether technology interfaces, which brings in, manpower efficiency or productivity efficiency or experiential gains, we bring that into our building. With management contract, of course, it's a asset light way to grow at somebody else's capital, who has a capital or a land bank or historical land bank, which you can unlock with your expertise. But it also needs a different kind of a nuance. So the value you create from the owning the asset, it's a firstly multi-generational perpetuity asset. It's a hard asset. So it's fairly safe and secure in a country like India. Secondly, it's a 20x value because the fee value is to the extent of that value. When you manage a hotel for somebody else, you create large part of profit to that owner of that building. But at the same time, you get a fee and a brand value out of it, which if you look at, Interglobe Hotel is the second largest owner of hotel rooms in this country, only behind IHCL. With Interglobe and Accor, our JV partner, combined, we manage 10,000 plus keys, of which 5,800 plus keys we own. So we put the money where our mouth is. On top of that, we create a large footprint with the asset light. And we have signed about 4,000 keys in last year, plan to sign a lot more in coming years and current year. So it's sometimes you also unlock with management contract, you unlock the value that individual owners may have in those tier 2 cities. So India is a diverse country. Somebody may own a land in Assam and have a great connect with the local community and has the ability to create greater value as a partner there of a asset owner, and we being operator with the global standards. So it's a mixed bag. and but both are needed hand in glove and go together to create the true value and a long-term, sustainable value. So hope that answers from the cost side, structural and growth perspective, balancing between management agreement and the asset ownership.
No, no, we also have a similar view. We agree basically the asset-light models are kind of clearly driving scale and capital efficiency, like you said, and then maybe ownership remains strategic from long-term value creation. So in the gateway cities or flagship or the brand defining assets is where, you get more return on capital employed on those kind of assets. So
Yes.
thank you, Vinay, for that. Sawa, moving on to you, I would like to get you, over here. And if we look back at the previous hospitality cycles, supply often expanded aggressively during peak demand phases. We've seen, and then we've seen the credit ratios, like, Swatantra was showing in the presentation. They've not been historically too good how they are, because of kind of supply, or the oversupply coming in the market. So from a credit perspective, are you seeing better underwriting discipline this time around, or, or are there early signs of history kind of repeating itself? Though we are talking and believing, that this time this is more structural in nature and we would not see the spike. But could you share your views around that?
Yeah, sure. So if we compare this cycle to the previous expansion phase, we see a lot of structural improvements. The balance sheets across hospital rated hospitality players, they are much stronger in the current cycle compared to the past. Leverage levels are much lower, refinancing risks have reduced, and cash flows have improved significantly over the past 2 years. And incidentally, this is not true only of the hospitality industry, but broadly to a great extent, it is across the board, across various industries. So that's more or less a macro factor what we are seeing. Second thing is within the hospitality industry also, a large part of the total expansion is happening through asset light models, which I think our panelists also spoke about, which inherently limit the capital intensity and debt levels during the expansion phase. However, having said that, underwriting discipline is something which has to be monitored, and it will also depend upon realistic stabilization assumptions. Obviously you would expect that only when revenue from the current streams of hotels which are under implementation are completed and the next cycle of uh, expansion begins. So as a rating agency, we will closely be monitoring the ARR sustainability, project cost escalations, and the pace of supply concentration in specific markets. So if we are, if I have to sum it up, we are not seeing sector-wide, overheating or buildup of debt, but there could be certain selective pockets which could become vulnerable if demand slows down and there's a uh, significant bunching of capacities in that specific market.
Sure, sure. It's also because I believe a lot of players have kind of delevered, in the last 2 years after the COVID. So we are sitting on a lot stronger balance
Yeah,
sheets.
and this is across all industry. I mean,
Yeah,
you see that not only in hospitality, but across all industries. And the fact is that the regulators, the Reserve Bank, everyone, they have also, ensured that a lot of credit discipline is being maintained across several industries.
sure, sure. So with this, Vivek, I'll just probably get your views on something which, we keep discussing. And though, like we're talking this time, the cycle is more structural change. But if we see the fiscal of 25, which is completed, and even 26, which we are currently into, we've seen the RevPARs been growing at a very, very healthy rates. So from here on, I'm not so sure, that similar rate, because we are also on, the base is increased. So earlier the base was a lot lower and it was easier to kind of get that kind of growth. But now since we're sitting on a higher base, how do you see the RevPAR? And also, according to your thing, is the momentum likely to be driven more by the rate expansion or the occupancy gains, which will happen because of this kind of a demand coming in, say, in the gateway cities? Because gateway, I'm not so sure. I mean, though supply is there, but lot supply coming in because of the land availability being so much only in the gateway cities. But maybe, some kind of a revenue management or the occupancy gains can kind of get that kind of growth. So what is your view, maybe 2 years from here on?
So I think that's a very balanced and a very interesting question that you posed. Uh, we'll divide it into two parts. Part one is towards the gateway city side. The momentum is pretty strong, while the occupancies have been extremely good and healthy. And I'm talking year round, and it's only growing. There is room for more. Um, ADRs will be the way forward for sure. It will be rate led because occupancies are peaking in various categories of segments of
Okay.
hotels. In tier two and tier three cities, there is room for more occupancies, and hence there has to be a very logical, rationalized approach towards the price point with which the rates need to be charged. Yes, some of the cities have shown some great resilience and robustness in surging up on their average rate that they go with, and I think RevPAR for sure is there, but it could be moderate to better. But in gateway cities, I would imagine the RevPAR growth should be in double digit, or just the early part of the double digit, in my opinion. Uh, and I think apart from RevPAR today, hospitality players and brands are also looking at TrevPAR, which is total revenue per available room, where
Okay.
today they are not only focusing on what is the revenue per available room, but they are looking at what is it that it can encapsulate comprehensively towards the facilities and services that a hotel establishment is offering in terms of sweating the asset is very, very
Yeah.
important. And how much are we able to generate from various other streams of revenues that we can very much leverage and enhance the experience, A, the quality of offerings, B, and C, more prudence towards revenue management that we should look at holistically for running a brand. So I would say this is here to stay and only grow. And I would peg it as an early double digit growth for this. Thank you.
Sure. Thank you. Thank you, Vivek. That was an interesting. So, Vinay, do you concur with what Vivek has? Say maybe a year down the line or 2 years down the line?
So look, it won't be a straight line per se. However, our rates are still suboptimal.
Hmm.
And Vivek touched on very valid point. The growth is not only room function anymore. What he refers TrevPAR has a larger component of food and beverage. Social consumption, neighborhood consumption is on a growth. There is also a lot of innovation happening in the product. Hospitality has embarked in last 5 to 10 years on lifestyle products that are offering a lot more food and beverage optionalities, um, far superior catering and events spaces, a lot of wellness-led activities, what Vivek was earlier referring to as well. So one would need to balance this all, and there will be growth in domestic consumption as well. Our domestic market, whilst we talk about 1.4 billion people, the consumption is only driven by less than 10% of that 1.4 billion. As that strata continues to grow, and there is a reason why Delhi Airport is amongst the top 9 in the world from traffic perspective, because mobility comes first, then comes the hotel. Whereas Delhi as a city is 60th ranking branded hotel supply. And with that gap, a quality products, branded products, and our yields are not very high. They are not obnoxious. We are not, our real estate cost is still very high. You yourself mentioned land availability in gateway cities is so restrictive. Construction costs are high. So people sometimes misunderstand when hospitality is charging 10, 12,000. rupees for a night, it's not all profit. It's returning some of that shareholder capital, which Sabyasachi was talking about, protecting that capital, mitigating credit risk, healthier balance sheet. Last piece, and this is, we had hardly 3 or 4 listed hospitality players in the market only 5 years ago in the country. Today, we have far deeper reach of public capital, and that capital source is strengthening the balance sheet more than other industries in this industry. I know everybody's balance sheets improved, but that has also brought in a differentiated capital into our business. That will continue to flow. A lot more institutional capital. So India only started to see institutional capital flowing in back in early 2000s to 2010 onwards, which is bringing in a very long-term capital from pension funds to institutions who have a long waiting period, sovereign funds from Singapore bringing capital. So it's an integrated change. It's a structural change. I wouldn't want to look at it suspectively at this time. It's too early. I think we are mimicking what US and Europe experienced 1960s, 70s growth cycle, which was a little bit longer than traditionally what's been experiencing, particularly in hospitality, because the gap existed so much. And we hope that consumption continues. Of course, we prepare ourselves with efficient building and cost structures, better balance sheet. But we also hope that this demand should continue at least for a sizable period for us to build right infra around it.
Sure. While we are already bullish, Vinay, but what are the 2 risks, that you would say that deserve a close monitoring, maybe, from an operator perspective or from a brand perspective?
Yeah, of course. There are risks, and we all observed whilst we were excited with AI, and every one of us was celebrating India's active participation. But it also brings in risk for ITES, which contributes significantly to our export and demand side. The gateway cities, when we talk about Bangalore, Hyderabad, and Delhi, all of them have sizable component from ITES, Hyderabad and Bangalore in particular. Bombay and Delhi are still diverse, a bit more diverse demand side. So their dependency on those and any structural change would bring significant short-term blip at least. There is GCC transition, there may be manufacturing transition, which may compensate for it, but may not happen overnight. So those are definitely a risk. We are so concentration risks in these markets. If you are highly exposed with Bangalore is our biggest grade A market, 200 million plus square foot of grade A. Hyderabad is 150 million, and we see the high vacancy rates already existing in Hyderabad. Now, how do we mitigate that if cycle softens? We all heard ET capture, and I don't know if it's accurate or not. I'm just reflecting on it, that top 5 IT companies have added 17 people collectively in last 9 months to their workforce, which used to add about 20,000 people every year. Now, they are obviously seeing something for not to strengthen, and that would have implications. So we have to be mindful of it. There would be concentration risk, but in saying that, our demographics, our shift to industrial, we are far behind in hotel room supply compared to China. China has multiple cities with nearly 1 lakh rooms. Our biggest is Delhi with 25,000 and 5,000 coming. So there's a long way to go. But in the journey of that decade, there could be few years where one needs to be prudent, have the balance sheet, what you talked about, interest cover ratios, keep healthy equity in the play and not over lever, and be prudent with cost and operative side, which we have learned. I think when your presentation was happening, there was a significant shift of early teens EBITDA margins to now 29. Good players are delivering mid 30s to mid 40s EBITDA margins. You see the quarterly results with the listed entities.
Yeah.
So there is still a diversity. So keeping that in play would only ensure long-term sustainable growth.
Sure, sure. Thank you. Thank you for that insight. And Vivek, for you, I mean, whatever the risk Vinay did share, maybe, a little color on that. And also, though currently also the 85 and 90% of the demand is domestic, but do you believe that the Indian hospitality, there is a lot of geopolitical disruptions kind of happening and FTAs are kind of not picking up, and there is a significant growth that we do get, when we have these FTAs in our hotels. So how do you see that piece? Also, maybe what according to you would truly differentiate, say the winners in the next phase or the current phase that we are into?
Good. No, I think thank you for that. I would certainly see that the uh, FTA arrivals, will improve given the geopolitical unrest that our country is surrounded by tries to make things a little more stable because there's a lot of uncertainty right now, and individuals from the West are a little wary of travel towards this
Hmm.
part of the world. There are advisories being issued, uh, from different countries, etc. But there is instilling a lot of confidence when, let's say, a head of state is traveling. It it makes a statement, and that head of state travels with their own business delegation, and that delegation need not necessarily be arriving into Delhi or into Bombay. They could be arriving into Bangalore as well. They could be arriving into Ahmedabad or any other city. They are visiting these places and they're making a very strong pitch and a sentiment that India is a preferred choice for a lot of things, be it AI summit, be it any kind of summits or sporting events or any kind of congregation of like-mindedness of minds is existing, and it is here to stay. The slowdown will not affect India at all. We shouldn't be worried about it at all, like our honorable prime minister and honorable finance ministers have also assured. And I think we can already see that impact is not really making a difference on us. We are quite a resilient economy, and because of the domestic thrust as well as the international arrivals and travels that are taking place, bringing in summits and conferences into our country, we should see the robustness. Uh, what will be the Who will be the real winners in the next cycle? In my opinion, um, uh, I think it's very important that as an industry, we must recognize that it's very important that our financial prudence and discipline is very important. We must bring in operational efficiencies, which COVID has actually taught us to be able to sustain that lever. Our manpower planning and productivity monitoring is very, very critical. Our energy management, because this is again a very big cost that is sitting on our balance sheets apart from manpower, needs to be managed well, including our procurement costs, because there is a rise in procurement costs for us as well. Uh, Greater leverage of technology and related tools will be the future that I would see, or we would see, getting enhanced in the hospitality and hotel industry. Driving better retention and loyalty of customers is going to be a very, very good and important strategy. In fact, we've just launched our brand new dining program called the Lalit Dining. And just a few months ago, we launched our Earn and Burn program called the Lalit Loyalty. Training and upskilling of teams will be very critical to drive consistency and quality of service delivery. And most importantly, also is embracing our diversity, equity, and inclusion practices in embracing employment opportunities that we can generate as an industry to those who matter the most and cannot be, appointed by other set of industries or cared for. So I think we are very proud at the Lalit of employing close to 300 individuals from all walks of life, be it LGBTQIA community, neurodivergent community, persons with disability, acid attack warriors. And I think it's only here to stay and grow. And we learn with each other. And lastly, it's about the sustainability practices that we all must adopt and really enforce miles ahead to be able to make a difference to the society and the economy at large. Thank you.
Thanks, Vivek. So as kind of, we are heading towards the closure, but we have few questions from our participants, which I would like to pose to you and Vinay. Maybe, there's a participant, Ramamurthy, who's kind of asking, maybe Vinay, you can take this up. She wants to understand what in the current scenario is the room key capex, maybe across each segment in the major cities as on date.
It's difficult to answer this question. Obviously, large part of cost, almost 30%, goes into land cost.
Yeah.
And land is not only city-driven, it's a curb-driven. So where in that city that land parcel is. But if we look at pure development cost, I refer to a term called GFA, gross floor area, how you build your hotel between room and other spaces decides what kind of money you spend in building that. Because it's pure construction and ID costs. More you build, more you treat the spaces, and more construction, more HVAC. Mid-scale hotel, anywhere between 50 to 60 lakhs per key. Upscale hotel, anywhere 80 lakhs to 1 lakh per key. 80 lakhs to 1 crore per key. And upper upscale luxury can be anywhere 1.5 to 2.5, depending on what kind of luxury you're going in. These are the various parameters with which you can kind of benchmark, but the nuance, and like they say, devil is in the detail. Land parcels, room count,
would make a difference,
public spaces, brand, so on and so forth. But these are the thumb rules, and these thumb rules apply to, on an average, at least 100-room hotel. Under that, these numbers get skewed.
Sure. Thank you. Vivek, we have a next one as well. If I can pose this to you, do you see real competition? I mean, though we talk of hospitality as a space, but only coming from the player perspective, do you see real competition coming from this segment of OYO and Airbnb platforms to you? Or how do you see this segment?
In the luxury space that the Lalit operates, OYO and Airbnb is definitely not perceived as a competition, because it's different strokes for different folks.
No, I believe what the participant may be asking is, not in respect of your thing, but generally
Right.
as a hospitality as a space. I mean, maybe the hotels, the luxury, the mid-scale segment, or otherwise.
So yes, OYOs and Airbnbs are definitely, in a way, aggregators that may have given wider choices today for a consumer or a customer to opt for. Predominantly, I would say in tier 2, tier 3 cities, a lot of listings have gone up where individuals didn't know, and today people are opening their doors towards homestays, towards OYOs, towards little boutique experiences that they may want to do at different price points. And yes, it's a good competition. It's a healthy competition to have for the level playing field that segment of players that exists, for sure. that definitely exists. But I thought there is a question from Mr. Hari Krishna, which says, is there any positive impact in hospitality industry on the arrival of onshore client from abroad towards Indian IT companies for business meet? I thought that was a question that perhaps was coming my way, but there definitely has been a positive impact, if I can put it in short. Definitely, yes.
Okay, thank you. Vinay, it's very interesting one, maybe the one that you were answering. So we have another participant who's asking, do you think that the lower greenfield opportunities in the gateway cities, they are effectively increasing the cost of acquisition in the tier one and two, and especially considering the focus on expansion for the larger players?
Yes, of course. And in our country, real estate is sometimes ahead of the rest of the market because the concentration of capital in real estate. There were times when South Bombay was more expensive than Manhattan with 1/10 of the room rate. So it does make it. So that's where our ingenuity to create hotels in the tight land parcel. I'm proud to say we have built in 30 cents of acreage, which is around 35, 40 cents, 1,400 square meter land in Bombay, 205 room hotel. So how to build on a tight footprint in a BKC kind of location comes to the stronger disciplined players in the market. But finding the good land parcel would be hard, and the way the cities are expanding, but it'll also bring opportunities in the fringes, new suburbs. City keeps moving. Hyderabad, we have seen how city has moved from, Jubilee Hills, Banjara Hills to high tech, now to Gachibowli and far and beyond. So those micro markets will keep coming in a gateway city itself. Tier 2 cities would always, at the moment, from the land perspective, they have plenty of opportunity. They're easy access. They are not so dense. So tier 2 has a lot of opportunity, but the demand side of the tier 2 city is more social driven. It's not as deep demand. It's not as diverse demand. And so one needs to be very careful understanding the market.
Okay. Thank you for that one. I think we have more coming, but we are kind of running out of time. So maybe, if I have to summarize, we all believe that demand is kind of broadening and supply is currently more disciplined than in the past. And that will kind of support our key performance indicators across the sector and the segments, is the house view. But sustainability will obviously kind of hinge on the pricing power, we spoke of the execution discipline and the capital prudence, like Sabyasachi also mentioned. So thank you, Vinay, Vivek, and Sabu, for sharing your thoughts and a very forward-looking perspective as well. We truly appreciate you all taking out time and joining us today. We will close the session and we'll engage separately. Yeah. Thank you so
Thank you.
much.
Pleasure.
Thank
Thank
you.
you, everyone.
Thank you very
Thank you,
much.
everyone.
Thank you for having us, and
Thank you,
all the
Mr.
very
Chakra.
best.
Thank you, Mr. Gupta. Okay.
Upwards and onwards. Thank you.